All right, welcome to The Explainer. Today, we're diving into a global shell game that's worth trillions of dollars. It's this high-stakes battle between the world's biggest companies and the US government over international corporate tax. And we're going to show you exactly how it all works. So, it's a question you see in the headlines all the time, right? How do some of the biggest, most profitable companies on the entire planet end up paying shockingly low tax rates? It seems like some kind of magic trick, but it's not. It's actually a very carefully designed system of legal loopholes and some seriously clever accounting. And the answer? Well, it lies in these incredibly complex profit-shifting structures. And they've got these names that honestly sound more like something you'd order at a pub than a sophisticated financial strategy. The most famous one, of course, is the double Irish-Dutch sandwich, a scheme that for years let companies make billions in profits just kind of vanish, at least for tax purposes.
Okay, so let's actually break down that sandwich. To really get to the core of this whole puzzle, we need to look at exactly how these schemes were built and the key legal entities that made it all possible.
So the main player in this international game is something called a controlled foreign corporation, or CFC for short. And put simply, it's just a subsidiary of a US company that's been set up in another country. So legally, it's foreign, but in reality, it's controlled from right here in the US. And that distinction, well, that is absolutely central to how all this profit shifting works. All right, this is where it gets really clever. Picture this. A big US tech company makes a sale in, say, Germany. That money lands in its first Irish company, but it doesn't stay there for long. Now, that company immediately pays these massive royalty fees to a shell company in the Netherlands. That move is tax-free thanks to some EU rules. Now, the Dutch company, it's just a pass-through. It immediately wires that money to a second Irish company. And here is the masterstroke. That second company is legally managed from a tax haven, like Bermuda. And the result? Billions of dollars in profit become effectively stateless. They don't belong to any country, so they're not taxed by anyone. It's brilliant, really. For decades, this was the playbook. So you gotta ask, how did the US government try to fight back? Well, their first major attempt to solve this puzzle was a piece of legislation that goes all the way back to 1962. They called it SubPart F, and it was the government's first real swing at this problem. The whole goal was to stop US companies from just hoarding profits in these foreign subsidiaries to avoid US taxes pretty much forever. You could say this was the opening shot in what would turn into a decades-long battle. Its strategy was really surgical. Instead of trying to tax everything, it created this blacklist of specific types of income that were super easy to move around artificially. Things like royalties, dividends, and interest. This stuff is called foreign-based company income. And if a CFC earned this bad income, SubPart F basically said, nope, we see you, and we're taxing that money right now at the full US rate, whether you bring the cash home or not. But here's the thing. While SubPart F was a decent backstop, corporations got more and more creative. It's what they do. They found loopholes, especially when it came to their most valuable stuff, their intellectual property, like patents and software code. They figured out ways to classify that income as active instead of passive, which meant it just slipped right past SubPart F's defenses. It became pretty clear that the original tool just wasn't enough anymore. The fact that SubPart F couldn't stop all this IP shifting led directly to the 2017 Tax Cuts and Jobs Act. And that law created a brand new, powerful weapon in the government's arsenal, GILTI. It stands for Global Intangible Low-Taxed Income. Now, what's really fascinating here is that GILTI takes a completely different approach. Instead of blacklisting specific types of income like SubPart F did, GILTI's goal is way broader. It's designed to impose a global minimum tax on pretty much all foreign profits that aren't already being taxed at a reasonably high rate somewhere else. Okay, to understand how GILT actually does this, you gotta know about something called QBA. I know it's a mouthful, Qualified Business Asset Investment, but don't let the name scare you off. It's just a fancy government term for all the physical, tangible stuff a company owns overseas. Its factories, its machinery, its equipment. And this is where the magic really happens. The GLT formula is actually deceptively simple. It takes a foreign subsidiary's total income, and then it lets them subtract an amount equal to a 10% return on their physical assets, their QBI. The law basically just assumes that a 10% return on tangible stuff is a normal profit. Anything above that is considered excess profit, and the law presumes that profit is coming from intangible things, like patents and brands that have been shifted offshore. And that excess profit, that's the GLT income that gets taxed.
So now we've got the old rule, subpart F, and the new rule, GILTI. But the key thing to remember is that GILTI didn't replace subpart F. They actually work together as a team, and they form a really powerful 1-2 punch against tax avoidance. Okay, so here's the crucial point. Think of subpart F as a scalpel. It goes in first, and it surgically removes these very specific, clearly defined types of bad passive income. Then, GILTI comes in right behind it like a giant net. It doesn't really care what the income is, just how much of it there is. It's designed to catch almost everything else that tries to slip by. So, the big question is, did this new 1-2 punch actually work? Did it really change the behavior of these massive multinational corporations? Well, the answer seems to be a pretty resounding yes.
Yeah, the evidence shows a pretty significant impact. Economic studies estimate that these new rules have cut down on offshore profit shifting by somewhere between 20 and 30%. And when you're talking about trillions of dollars, that's a huge number. I mean, to put that into perspective, U.S. multinationals were holding a staggering $2.6 trillion in offshore profits right before these rules went into effect. GILTI directly attacked that mountain of cash, and it forced companies to restructure and caused that number to finally start shrinking. And we saw some very public responses, too. For instance, Google, probably the most famous user of the double Irish Dutch sandwich, announced in 2019 that it was completely dismantling the scheme and bringing its intellectual property back home. That was a direct reaction to this new tax landscape, making the old tricks a lot less profitable. The power behind this change is what experts call the GILTI stick. The law is really cleverly designed so that even if a company pays taxes in a low-tax country like Ireland, they'll almost always owe a little bit more back here in the US. That small but certain residual tax, it acts as a penalty, a stick, that just makes parking profits offshore a whole lot less attractive. And this whole system is still evolving. The GILTI effective tax rate is already scheduled to go up in 2026, from 10.5% to over 13%. And that pushes it much closer to the 15% global minimum tax that's being advanced by the OECD, which really signals a much broader international agreement against these kinds of avoidance schemes. Which, leaves us with a final, pretty provocative thought. This cat-and-mouse game between global tax authorities and multinational corporations is obviously far from over. As the rules get tighter, the accountants and the lawyers just get more creative. So the big question really remains, will today's powerful solutions, like GILTI, just become tomorrow's loopholes?